There's a familiar stock on Yahoo Finance's trending ticker page this morning. It's AMC. 2022 may have been a bad year for names like AMC and other contemporaries like Carvana and Peloton, but 2023 so far has been giving them some upside. One strategist thinks that rebound is temporary. Here's a look at some of 2023's winners and losers and whether they're going to continue to be with Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. Hey, Amy, good to see you. So you call some of these names trash, to put it simply. Do you put AMC and some of those others I mentioned in that category? And how do you think they're going to continue to trade here?
Yeah, it's a good question. I guess that's not very nice, is it? But we do have a more quantitative way of looking at it. We essentially call those names our low quality basket, so this is kind of agnostically sweeping through liquid option names. Who has negative free cash flow, who has leverage, who has debt in a rising rate environment, who has negative net income, and unfortunately, AMC, GameStop, Carvana, all these names that I think everyone became quite familiar with in 2020 when stimulus checks went out. Those were the losers of 2022, but they have really rallied sharply in 2023. But, the fundamentals haven't changed. These are still low quality names facing what is a pretty abrasive environment ahead.
So what's within this move that we've seen in 2023, early days at least, for those names that have been rattled, the fundamentals hadn't changed over in 2022 and they declined precipitously, to what extent was it just investors buying on hopes of a rebound or a bounce off of some of that move lower, or perhaps even a short squeeze in some of those instances?
Yeah, look, I think the technicals in particular in the beginning of the year has a lot to do with the action we saw year to date. Tax loss harvesting and then rebuying back into the market is also related to that. Another thing is just simply when you look to participate in leverage, you go with the momentum first. And one thing that we saw that was really unique about 2022 is essentially hedging stopped. So investors didn't buy downside protection. Skew became very low. People kept asking me, what is going on? We don't think that the market environment is great. So why is skew essentially disappeared? My answer was when cash yields 4% and you can park it there, you don't actually need those hedges in the same way. So this may sound a little counterintuitive, but skew has actually returned to the market because people have kind of started to wade back into the pool. So you can view it as concerning in the sense that people are starting to protect what they have, but also it means people are participating more in the equity market than they were kind of towards the end of last year.
Well, and if they're hedging also, doesn't that imply that if they're protecting themselves, isn't that a positive thing? In other words, wouldn't the downside maybe be less than if one of their trades didn't work out?
Yeah, exactly. So for those who are participating, obviously you're kind of ameliorating that downside, but it does kind of mean that cost of protection starts to rise for everyone else. And then the other thing I would say is, in the options market, it gets a little muddled, Julie, because there's sort of the short term where we look at anything from 1 day to 1 month. And then there's what we consider the long term, so 4 months or even longer. And those still tell two quite different stories. So longer term, there is a lot of that hedging, but you don't see that as much short term. You actually see a lot of this kind of craziness with zero data expiration options, crazy volume there, as well as this bid for upside. So people trying to get into the market rather than protecting it, which is what we see longer dated.
So kind of early year, we were also looking at, on a sector front, discretionary, consumer discretionary, as well as the bounce that we've seen in technology. What would you say of that? And is that kind of expected to continue? Is that something that you expect to wither on the other side of that?
Yeah, to be quite honest, it's a really difficult question. And part of the reason is, when we looked at our trash basket, our low quality basket, whatever you'd like to call it, a lot of the names that were on it in terms of airlines, cruise ships, all of these were related also to the China reopening. So you have a name like Wynn, which obviously benefits as the casinos reopen. You have airlines as people start traveling to and from China. And so there was this bump because, everyone expected at some point that China was going to reopen. We were really uncertain about the time. And I think it essentially came earlier than investors expected and way more full force. People, I think, were expecting something more gradual. The question we're contending with now is how much of that has been priced in, and you're left with these stocks that have done quite well, but they remain low quality and they remain quite leveraged. And how does that look going forward?
So if we look out to 2023, we talked about a couple of things that you're expecting: hedging demand already coming back, what's going to happen with these low quality stocks, to put it a nicer way. And then finally, what's going to happen with volatility as we head throughout the year?
Yeah, so, I think volatility really, really surprised a lot of us last year, but I do think this year is going to be a little bit more of the year of normalization. So what do I mean by that? First, we are going to start to see VIX hit that psychological 20 floor that tends to happen in higher environments of cross-asset volatility. So, rates vol remains extremely high, FX vol remains extremely high, and you are seeing that return of hedging. And then the second thing I would see is there has been this focus on, people call it Volmageddon, but essentially this focus on very, very short-term options, these zero-data expiry options. I actually think that focus lessens and you pay much more attention to the larger hedging story, which is much more long-term. And by long-term, I kind of mean the 3, the 4, the 6-month territory.
Long-term in the options world, right? Amy Silverman, thanks so much. Head of Derivative Strategy at RBC Capital Markets. Good to see you. Thanks, Amy.
Good to see you.